Meet Lex Van Dam. Lex is one of London's top professional traders with more than 20 years' experience. He is the creator of BBC Television's $1 Million Traders and the author of How to Make Money Trading. In $1 Million Traders, he risked $1 million, proving he can teach regular people how to become successful traders. After an intense training course of 2 weeks, he gave them $1 million of his own money and challenged them to profit from the stock market. Crazy or inspired? The risk paid off, with his newly trained team outperforming professional investors over the same time period. Now, for the first time, Lex is bringing his unique knowledge and understanding of making money in the city to everybody, and will show you how to trade stocks like a pro. Welcome to 5-Step Trading.
Hi, my name is Lex Van Dam. In 5-Step Trading, I will teach you the steps you need to follow to become a successful trader. 5-Step Trading draws on everything I've learned about trading in the equity markets, and also builds on the training program I put together for $1 Million Traders. Luckily, trading is not as complicated as the so-called investment experts would like you to believe. But you do need to be prepared to invest in your own future by learning new skills. And you do need to realize that a casino mentality is not going to make you rich. At times the material may seem easy, especially if you have been trading for a while. But at other times it will be challenging. My advice is to persist, and if necessary, watch the videos a couple of additional times. The traders in $1 Million Traders came from a wide variety of different backgrounds. Why wouldn't you be able to achieve what they did?
With the help of Lex, we'll break down each step.
In this course, we will cover everything you need to know about trading stocks. The first step in 5-Step Trading is idea generation, and I will explain how to find good trading ideas. I will also discuss why it can be costly to follow other people's trading ideas without doing your own checks first.
In the second step, we will help you decide whether your best ideas make sense from the perspective of the individual companies involved. We'll look at what the company's business is and give you the tools to analyse company financials. Step 3 looks at trading from a technical perspective, and we will show you how to read stock charts. This will help you look at market trends and decide whether the timing is right for a potential trade.
Even when the first 3 steps have helped you find a great trading idea in a good company with a compelling stock chart, your work still isn't finished. Step 4 is designed to ensure that you are in the right state of mind to trade. We will look at common trading mistakes and how to avoid them. Trading psychologist Steve Ward, who was also involved in $1 Million Traders, will share some of his knowledge with you as well. Lastly, step 5 will show you how to protect your stock portfolio in the market, to ensure that even when you do lose money, it will be a manageable loss and not inhibit your ability to trade. There is a glossary on my website in case you are not familiar with certain concepts.
Original ideas are key to successful trading. We will show you why you need to have your own ideas, and we will show you how you can find good ideas.
Without good ideas, it's very unlikely that you will make money consistently. Most people already go wrong at this first step. They listen to people on television pushing certain shares, they follow their friends' tips, or they trade based on rumors from the internet. Wouldn't it be great if share trading were that easy? You wouldn't have to do any work and the profits would just keep rolling in. In reality, it's nothing like that. Whenever I listen to other people, I tend to lose money. And it messes with my head, because I'm never quite sure why I actually traded in the first place. Also, people will tell you only about their winning trades, and never about their losing ones. If you want to become a great trader, you will have to generate your own ideas and do your own research. There are just no shortcuts.
So, Lex, you recommend not to trade on rumours and other people's ideas or poorly conceived ideas from the media.
Yeah, exactly. Also, when you follow other people's advice to buy or sell, it's much harder to know what to do when things start going wrong. You become really uncertain. Should I get rid of the position? Should I stick with it? If it was your own idea in the first place, then it's much more straightforward to decide when to get out of a position. If the original reasons why you decided to own the stock are no longer valid, it's time to sell. It's really that simple. That is why it has to be your own decision when to enter and exit a trade. Generating your own trading ideas will help you do exactly that, and in a much more controlled manner. Blindly following consensus view, it's usually costly. Don't do it.
So, self-reliance and being the source of your own trades is a way of keeping in control of things as they change. You also mentioned the idea of consensus.
Yeah. Consensus means that the majority of investors have the same view about the stock. If everybody owns the same stock and people start to sell on negative news, then there may be no buyers left and the stock will go down very quickly. To find out if an idea is consensus, it's important to look at the stock when a piece of news comes out. For example, if the company increases its sales forecast and the stock price doesn't move up, then it might well mean that everybody already owns the stock and that the next move will be down. Following the herd might make you money from time to time, but in the long run, I can guarantee it will end up costing you. It's one of the main reasons why original ideas are so important.
Okay, so I see the danger of having the same positions as other traders. But surely we all watch the same business programs and read the same newspapers. So should we stop doing that?
No, of course not. Reading the Financial Times and watching CNBC and Bloomberg TV can be useful, but only if you do it in the right way. You need to decide if the news you get is price-sensitive information or if it has already been factored into the market. Trading on old information makes you the famous sucker of the stock market. It gives other people who bought the stock before you a chance to sell it to you. In fact, the aim is to have the idea before others, so you can sell it to them when the idea has run its course. Also, financial news channels often feature guests with very strong views and opinions, and these guests have been chosen because they make good television, not because they're good at predicting the future. The main aim of financial television is to attract viewers. That's not necessarily the same as making viewers money.
So watch for information, but not for shortcut trading tips.
Yes. Watch to see what the market is talking about. Find out what the consensus ideas are. Maybe even watch for your own entertainment. But whatever you do, don't follow their advice.
What other pitfalls are there that we should be aware of?
Well, just make sure that you know where the information comes from and that the source is reliable. There's lots of websites with conspiracy theories. Of course they're fun to read and look at, but they're unlikely to make you money. Also be really careful when you read about small companies. Maybe the writer already has an interest in the company and is fabricating a story to try and make you buy the stock so he can sell it. Normally this involves illiquid penny stocks.
What do you mean?
Well, penny stocks are shares that trade at less than £1, often even less than 10p. And the big problem with penny shares is that there's a massive difference between the price where you buy them and where you sell them, even when the stock itself does not even change. This can be as much as 2p on an AP stock, i.e. 25%. Penny stocks are often very volatile, halving or doubling in value in a very short period of time. It's almost impossible to make money in them. Professional investors hardly ever touch these types of shares, and I suggest that you stay away from them too.
Okay. So what have we learned so far? Newspapers are useful sources of information, but remember, they report yesterday's news. They do not predict the future. That is your job. Financial news channels are also useful, but their primary aim is to entertain, not to make you money. Your job is to analyse the news to find out what is new and could impact the stock, and what is old news and already priced in. If a stock does not react to news as it should, this tells you there might well be a consensus position in the stock. Let's now hear a few views from the trading floor.
Well, there's a few dangers to trading on other people's tips. First of all, you tend to find that the entries are very good, so you get to hear about the tip on the way in, but then on the way out you're never told about when to exit, and you could find that you're the last man still stuck in the position on the way out. So everyone's closed out their positions, and you're still holding on, selling that stock or that tip position at the bottom of the market. But buying the rumours, selling the fact is an old market adage, and it's all about any time there's an impending news announcement, whether it's economic or corporate, you tend to find that the price action will move in the direction of the impending news. So if there's a positive corporate announcement on a company, you'll tend to find that the price action moves up prior to that news announcement, and when it's been reported, when it's made fact, the price action will start to move back down again. People start selling into their news, so you're buying prior to the announcement and you're selling as soon as the announcement's made.
I found ideas in the Financial Times, although the market actually usually reacted by the time it was published. I found them by looking at external events from non-financial newspapers, and BBC News is a good source, of course.
The other thing you'll want to look at, and I'll go through how some of this works, and again, you don't have to be economists overnight, but you'll look at some of the economic data that came out overnight and see if it's better or worse. Bloomberg's a very useful tool for this, because you have what the people predicted and what actually came out. So the predictions is not the main thing, it's what actually came out versus the prediction that makes a big difference. For example, here in the UK, everyone's been talking about recession. Now look at this. The survey expected retail sales to grow at 4.1%. It grew at 8.1%. That's interesting to me, because that's against what we're thinking.
I admit it, I also got ideas from other traders, but of course herd instinct is very dangerous from the risk management viewpoint.
So, we've learnt how not to use other people's trading ideas, but how do you now go about generating your own original ideas? One way of finding good trading ideas is to think about how you behave as a consumer. Many successful fund managers use exactly this technique to find new ideas for their portfolio. Legendary investor Warren Buffett often uses this approach. He likes to drink Coca-Cola, thinks the company has a structural advantage, and so owns shares in Coke. So thinking about what products you buy in your daily life and the companies behind them is one possible starting point. This falls into the category of bottom-up analysis. Bottom-up analysis starts by looking at one specific company and its exact business. What products does it make and who does it sell to? Is it a new company with a lot of growth or an older one with a good steady business? Comparing a company to similar ones in the same industry might also enlighten you on the quality of the company involved. A company with better products may be in a better situation on the stock market too. But even if you think you have found a great company, you have to remember we are just at the first stage of step 1. Don't buy anything yet. Which company is the best for those purchases that you simply couldn't do without, such as your petrol, food, clothes and banking? Do you go to Tesco or Morrison's? Is your phone on T-Mobile or Vodafone, and why? Have you recently switched electricity suppliers? And where do you go if you have room to spend a little bit more? Do you buy the latest gadget? Or do you go on holiday? And which company do you use? Almost every decision you make as a consumer can be considered as a trading position. So that's how you use bottom-up analysis to find trading ideas. It's really based on looking intimately at individual companies. But what about if you want to trade based on wide themes, such as trends in the economy? Well, this is called top-down analysis.
Top-down analysis means that you find interesting themes and investigate them, and then determine which companies will be affected by the themes in question. For example, if you think that the pound is going to weaken, then this will benefit exporters who earn money in other currencies, because their foreign profits translate back into more sterling. So you could consider buying large international stocks, such as Glaxo, or Diageo. Or you might think that tax increases on oil companies are likely, and this might lead you to think about selling BP. It's extremely important to realize that a great company is not always the same as a great stock. As a trader and investor, you will realize that sometimes you need to sell companies that are great companies just because the stock price is not behaving well and you think the stock price will go down further. You cannot afford to fall in love with a company. Their only purpose is to make you money. You want a friend, you get a dog.
Let's have a look at two more examples of top-down analysis. Again, this is where the trading ideas come from a thematic approach. For example, let's say you think China is the future with robust economic growth. You can then look for companies with factories or sales in China. The table shows that mining companies, Xstrata and Rio Tinto, have 35% and 20% of turnover in China respectively. These mining companies export a lot to China, and any positive developments in China will be good for them. Of course, the flip side is that if Chinese growth starts to slow down, these companies might better be avoided, and you might even want to short sell them. Short selling profits from a fall in the stock price by selling a stock and buying it back later at a lower price. It is the opposite of buying a stock or going long. When you buy a stock at 100 and sell it at 120, you make a profit of 20. If your idea was wrong and you have to sell at 90, you have made a loss of 10. Let's see what happens in the case of short selling. If the stock is trading at 100, but you believe it will fall 10% to 90, then you can short sell it at 100 and buy it back at 90, thus making 10 profit. Of course, when you are wrong, you will have to buy it back at a higher level than you sold it for. If you end up buying back at 120, you will have a loss of 20. Short selling can be done to protect your portfolio or on its own as an outright trading idea. We will discuss this in more detail at a later stage. And you can also see this in practice on the $1 Million Traders DVD. For the second example, let's look at the shape of the UK economy. If the economy is slowing down, then people have less money to spend, which might hurt companies such as Marks & Spencer or Punch Taverns, who derive nearly all of their revenues from UK consumers. All the numbers used here are historical estimates, and we are using them purely for illustrative purposes. Remember, always be wary of using other people's forecasts. Always do your own research.
The number of possible themes out there is limited only by your imagination. So there really is no need to follow everyone else's ideas. Take demographics, for example. The population in the Western world is aging. So maybe you should buy some companies that provide care for the elderly. Or how about alternative energy? Oil is becoming more expensive and riskier to find and extract, so perhaps renewable sources like solar or wind power will be key themes in the future. Step 1, idea generation, is all about creative energy and coming up with your own original trading ideas. Unfortunately, as you progress through the stages of 5-step trading, a lot of these ideas will turn out to be the consensus view and thus unattractive. And that is why you have to go through each of the 5 steps and not start trading on hunches or impulses.
It's important to start with a top-down think about where the world is going and then apply that to businesses you understand. I started with ideas from the defence sector because this is what I knew and understood. And learning about something you're interested in and that you know something about is a good way of learning tips and tricks that you can then apply to new situations.
So now you know that you can generate ideas through looking at individual products and companies, which is what we call bottom-up analysis. Or you can find ideas through looking at themes, which is what we call top-down analysis. Now let's take a break with Steve Ward, a motivational coach for novice as well as experienced stock market traders. Lex has previously drawn on him for $1 Million Traders, using Steve to prepare the traders from a mental perspective. So let's find out what role psychology plays in the generation of ideas.
There are several key factors to consider in terms of idea generation from a psychological perspective. Now, one of the single most important concepts in becoming a successful trader indeed actually in becoming successful in any walk of life, is taking personal responsibility for your actions. When it comes to idea generation, Lex has talked very clearly about the importance of generating your own ideas and not being swayed by others. Now, you can only truly take personal responsibility for your trades if they are your trades. Otherwise, it's all too easy to blame the originator of the ideas. Also, by generating your own ideas, you'll feel more involved in your trading. And as you become better and more successful with your trading, your confidence will increase. If you take other people's ideas and recommendations, you will not build your own skill levels. And importantly, you will not build that base of confidence. When you take charge of your trading, you're in control. And this all adds to feelings of confidence. Again, adding to what Lex so rightly said earlier in the programme, if the ideas are yours, they're so much easier to trade. Taking profits and taking stops become more manageable when you understand why you're in the trade in the first place. Finally, I would just like to say that every trader is different in terms of how they trade and also what they trade. One of the keys to successful trading is actually finding the type of trades and the style of trading that best suits you. A bit like with jobs where different people do well in different roles, and in sports where different people excel in different sports, and even positions within those sports. Finding your niche is very important. You should be over time looking to play to your strengths, your interests, and where you're most profitable. You will gain a far greater sense of satisfaction and ultimately be more successful as a trader if you take the time to develop your trading skills and learn to generate your own trading ideas.
When you generate your stock ideas, it is wise to understand the economic and political environment in which you trade. Is right now really the best time for your trade? Do you really want to buy a company that sells luxury goods if the economy is falling off a cliff? And do you want to buy a boring water company if the economy is growing fast? Chances are that the state of the economy impacts the performance of the stocks you trade.
The business cycle reflects the tendency of economies to move through periods of boom and bust, with fluctuations in economic growth typically occurring every 5 to 7 years. Different sectors of the economy perform better at different stages of the business cycle. So, if you're able to figure out where we are in the cycle, you can generate better ideas and increase the chances of making money.
Good traders and investors are always aware of where we are in the business cycle to help decide whether the timing is right for their trading ideas. And so should you be. Instead of performing a typical business cycle analysis, I want to discuss some great work produced by strategists at investment bank Goldman Sachs.
The analysts at Goldman say that the business cycle can be divided into 4 distinct phases: despair, hope, growth and optimism. Let's start with the despair phase. This happens in times of economic weakness and is characterised by people fearing the economy may never recover. In this period, the stock market normally takes a battering. Of course, some stocks do better than others in this phase. Different stocks to those that do well in other parts of the cycle, as we'll see in a minute. Luckily, despair does not last forever. The hope phase takes over when people begin to realise they were being overly negative, also called too bearish. As people start to anticipate economic recovery, the stock market goes up sharply. We call this a stock market rally. When growth actually starts to emerge, it often turns out that the actual economic recovery is not as strong as was anticipated, and that expectations were too high. The market has already factored in most of the good news. It still rises, but not as aggressively as during the hope phase. In the optimism stage, the economy continues to improve, but the market begins to extrapolate that this recovery will last forever. The stock market will rally hard again. However, at some point, the actual economic growth will cease to keep up with the consensus forecast and the market will begin to fall. So in the optimism stage, the returns can be phenomenal. But at the inflection point, the market can correct heavily and will be followed by the despair phase, where it seems we will never get back to normal again. It is amazing how stock market history repeats itself. This is a function of market psychology and economic theory, which has withstood the test of time. So how do we work out in which of the 4 phases we are in and which sectors do better during each period? What are good sectors to invest in during the despair phase?
During a typical despair phase, the healthcare, utilities and oil and gas sectors do best. They are defensive sectors with relatively consistent earnings, independent of whether the economy is in recession or not. But they can still go down in value. The point is that they are generally strong performers relative to a weak market.
What happens in the hope phase?
In the hope phase, those sectors that almost went bankrupt in the despair phase perform best. Think here of sectors that have a lot of fixed costs, such as the auto industry and the chemical industry, that really need economic activity to survive.
That brings us to phases 3 and 4, the growth and optimism phases. What stocks should I buy now?
The more upmarket travel and leisure segment tend to do well in the growth phase, as they may have lagged the market and people start to take more expensive holidays. Oil and gas shares often perform okay as well. But it's the exploration companies that will benefit the most this time, as the larger integrated oil companies are more defensive. Real estate also typically does well, as property values tend to go up significantly. Finally, in the optimism phase, the winning sectors tend to vary. It is often based on the latest technological developments. 100 years ago, it was car and railway companies, and at the turn of this century, it was internet companies. It really can be anything. History has a habit of repeating itself, but unfortunately, it's always slightly different. So some stocks that did well in the last hope phase may do badly next time around. If a company has changed strategy, it will perform differently in the next cycle. Also, politics can play a big role. Maybe the government wants to help a certain industry, such as solar power, and tax another industry. These are variables that change over time. So don't make investment decisions based purely on what happened in the past. What worked yesterday might not work tomorrow. The main point to take away from this is that you need to be aware that the economic phase you are in will have a significant impact on the kind of stocks you should be buying or selling. If the economic cycle is not right for the company, you should just wait. Why rush? The market will be around forever, and I want you to be around forever as well.
The stock market is a forward-looking indicator of the economy. If the economy is expected to do well, stocks do well. And if the economy is expected to do badly, stocks usually will too. Conventional wisdom states that the stock market anticipates the real economy by about 3 to 9 months. This means that the stock market might start to rise even while current news is still negative.
Well, since my career to date had spanned many years in the provision of food products to caterers within the leisure industry, I initially focused on people like pub groups, so Punch Taverns, Mitchells & Butler, Greene King, Whitbread, and food manufacturers, which could include Tate & Lyle, and even food retailers, Tesco's, Morrisons, Sainsbury's. And I suppose I was already armed with quite a bit of knowledge on that sector, and I was also reading industry-specific publications that might give me a hint as to people that were winning or losing contracts, or it could be changes in legislation, all these things that might have an impact on their share value.
The other thing is use the web, spend some time, because there's all sorts of fascinating blogs that are out there now, especially the further out of this kind of basic FT Bloomberg you go, the more likely the information you get is going to be A, interesting, and B, not thought about by everybody. And sometimes you find, especially on the web, especially in stuff like oil and commodities and other things, you'll find there's a lot of kind of left field views out there. Some of those are very useful, and they'll give you a much better idea of what either the risks are or some of the opportunities, and some of these will generate some great ideas.
So we have discussed the despair, hope, growth, optimism model to help you with selecting stock ideas. To know what phase you are in, you need to look at some very important economic variables. Again, economic data is really important. Let's have a brief look at some of the key economic indicators. These indicators are not rocket science and are published very frequently in newspapers, on TV and on the internet. If we are going to talk economics, what better place to start than with interest rates and inflation? The interest rate is really the price of money. If interest rates are low, it tends to be good for the stock market. High interest rates are of course not helpful, as it makes it expensive to borrow money. Inflation is also an important indicator. Inflation means that prices of goods are rising. High inflation is really bad for the economy, as consumers get scared, because the price of their basic living expenses keeps going up. Deflation is the same as negative inflation, and this is very bad for the economy as well, as companies find it much harder to make money because they can't raise prices. The ideal scenario is stable inflation of about 2 or 3%.
These two charts show UK inflation and interest rates over the past 60 years. You can see that inflation has been all over the place. Sometimes it was 0 and sometimes as high as 25%. Same story for interest rates. Low at certain times, sky high at others. You can see how inflation has led interest rates. This 60-year picture puts recent history into an interesting perspective. Of course, there will always be stocks that benefit from higher inflation. For example, defensive sectors such as food retailing tend to do relatively well because they can pass on the price increases. But most sectors will do badly. GDP, or gross domestic product, is the next important indicator to look at. GDP is the value of all goods and services produced by an economy over a specified period. Steadily rising GDP is a good environment for corporate earnings growth. The chart you see here is the GDP per capita in the UK, currently just over £20,000 per person. However, GDP does not always go up. 2 consecutive quarters of negative GDP growth is called a recession and may not be a great time to own equity. Then there's unemployment. High unemployment is normally bad for the sales of a company, as it means that people have less money to spend. It can lead to lower input costs though, because employers are probably scared about losing their jobs and won't be asking for wage increases. However, this is normally only a small positive. The other implication of high unemployment is that jobless people claim more benefit from the government. This additional government funding needs to be made up from higher corporate taxes, just as the companies themselves are struggling. Lower consumer spending and higher corporate tax rates are negative for company growth and thereby for stock prices. Look at this chart and you can see that in the depression of the 1930s, unemployment rose as high as 20%. Hopefully we won't get there, but you as an investor need to realise that this is always a possibility. Higher unemployment also knocks consumer confidence. Consumer confidence is calculated by asking a sample of households how they feel about their own financial situation and the state of the general economy. When people are worried about the future, they spend less. It's a downward spiral. The less money is spent, the worse consumer confidence becomes, and that leads to even less spending. Consumer confidence wasn't great between 2000 and 2010, and nor was the UK stock market, which, as you can see, dropped quite a lot over these 10 years. Another important indicator is house prices. Ask the man in the street and he will probably tell you that property is a fantastic investment and that it will always go up in the long run. However, since 1890, US house prices adjusted for inflation have actually only gone up by 35% in over 100 years. That's less than 0.5% per year. This shows you that conventional wisdom is often very inaccurate. Obviously, house price dynamics vary from country to country. This is another reason to do your own analysis and idea sourcing.
Again, the reason I'm looking at these economic indicators is that I might have a trading idea, but I want to ensure that I'm not going against the economic backdrop by, for example, buying a house building company just before a recession sets in. Anyway, if I could only pick one economic indicator to help decide whether stocks are going up or down, I would suggest you look at the ISM. The ISM is published in the US by the Institute for Supply Management. And even though it's an American indicator, it's really key to global stock markets because the American economy is by far the largest in the world. Whatever impacts America impacts the rest of the world. The ISM survey asks the purchasing managers of major businesses a series of questions about the economic climate. This may sound vague, but the data is put together in an index, which has been published since 1947, and is a very good predictor of what the state of the economy will be like in about 3 to 6 months. The ISM is a number between 0 and 100. When the ISM is above 50, the economy is expanding, and when it is below 50, the economy will soon start to contract or is contracting already. The ISM moves in cycles in the same way as gross domestic product, but crucially it seems to precede the GDP cycle by 3 to 6 months. So the ISM can help us predict changes in gross domestic product, which in turn helps us predict changes in the stock market. This chart maps the relationship between the ISM and the US stock market from 2003 to early 2010. It can be used to estimate what is called the fair value for the US stock market, which will then help predict, for example, the UK stock market, and maybe warn you of a change in trend. You can find a more updated version and an exact explanation and stock market targets on the Academy's website. Unfortunately, there's no single indicator that you can always rely on. The minute you think one particular indicator is the holy grail, it will change and end up hurting you. Hopefully, economic indicators help you decide about the general market direction and improve the timing of your trading ideas, but realize that they are just one part of the 5-step trading process.
Having an informed view on the stock market direction will help you avoid buying stocks when the market is going down. The chance of a single stock bucking the general market trend is quite small, so you need to have a feel for the whole market.
Conventional wisdom is often wrong. Remember that house prices have risen far less than people generally think? Well, what about the stock market? Everyone knows shares outperform over the longer term, don't they? This table shows that equities go up about 5% per year on average over long periods after inflation. However, most stocks disappear in the long run. How many of the original railway companies are left? How many internet companies ended up making money? A few did, but most did not. And these rising charts never show the companies that ended up worthless. For a recent example, look at what happened to Bank Northern Rock. In the fairy tale of stocks going up 5% per year over the long run, can we really trust that this is what really happened? I don't. I believe that the actual return is much lower. This is because the 5% return per year assumes that people do not pay tax on capital gains and assumes that they don't pay tax on the dividends they are receiving when owning stocks. And thirdly, that all these dividends they get are reinvested back into the stock market. The truth is quite different. Most people do pay taxes on their investment income and they like to spend the money they earn. The following table shows that £100 invested 100 years ago will buy you the equivalent of £470 now, not more than £22,000, as it will be with 5% growth. That's just 1.5% per year, not 5%, as the experts would say. And if you then add the costs of hiring an expert to run your money, then it will be a miracle if you even earn that over the long term. The experts also don't tell us that the market is sitting on a demographic time bomb. We currently have an aging population, with pensioners having to sell the stock portfolios they have built up over the years to draw an income. And there aren't enough young people who can afford to buy everything the pensioners are selling. For a typical example of what happens when you have an aging population, just look at the Japanese stock market from 1970 to 2010. The following chart shows that the UK workforce, as a percentage of the whole UK population, has been declining since 2000. And that this will continue into 2020. It also shows that the stock market has followed the relative workforce number very closely. So when the workforce is going down over the next 10 years, which it will, then this tells you that UK stocks are in for a difficult period. Not a very popular statement to make. It is in the interest of the experts that people believe stocks go up, and that you believe they should invest your money for you. I hope that I have shown you why you should be very careful believing them. So like I said, I think that investing on the basis that stocks will go up in the long run is really dangerous. It also ignores that markets can go down a lot before they go up again. And not many people can actually hold on to stocks when they drop significantly, especially when using borrowed money, as we will see in step 5.
So let's sum up what we've just learned. You need to check that your trading ideas still make sense when you take account of the general economy and the expected stock market direction. There are a number of economic indicators that you should follow to get a feel for the economic cycle and thus the stock market trend. A great indicator to use to predict the direction of the stock market has been the ISM, at least till now. Nothing is forever though, so always be wary of relying on a single tool, and not all stocks go up in the long term.
So hopefully by now you have a pretty good idea of why you should have your own trading ideas and how to find them. The state of the economy really has a big impact on the kind of stocks that do well, so you really should try and think of that before you trade. In step 2, we will take your idea to the next step and conduct some proper company analysis to check if the company might actually be a good investment. See you soon.
Next time in 5-Step Trading, we will conduct some proper company analysis to check if the company might actually be a good investment.